Thank you very much, Luca. Thank you for all of you being here. I know many of you, so hello to my old friends, because many of you have actually been in my classes. I taught a course at the University of Pennsylvania that ran for 37 years. So many of you I know from that course. What I tried to do was not only focus, even though that is my specialty, on emerging markets today, this morning, but integrate also the advanced economies, because we are all in this world very much interlinked. The models that are developed often in advanced markets, but also vice versa, but really are applicable and should be applicable in emerging markets. So I try to combine the two different parts of the world, try also to combine the major challenges that we are facing at the moment. We are at a very difficult moment in time, so particularly with a view to the climate, and we all feel it. I still feel it in this room. It's very hot for all of us, outside and inside. So I want to focus a little bit on the challenges of the climate, the challenges of the macroeconomy, as I mentioned in my slides here. Then go to the, if you can, yes. Yeah, a little bit, because I'm in and out of the sun. The demographic factors, which of course play out very, very differently in emerging markets. No, you don't have to. I think I'm fine, as long as I, yeah. So, and then I will focus on the, oh, I have a clicker, much better, on the housing finance sector. Because the core point that I want to make is that if we want green markets to develop, if we want capital markets to develop, if we want affordable housing markets to develop, we cannot develop them just based on the numbers of need or demand. There has to be finance. Without finance, we have no markets. And therefore, I focus on that theme, coming back to that regularly. And then I want to split up the section in what are the core problems in advanced economies, and what are the core problems to get this housing finance market to work for climate, to work for affordable in emerging markets. So it is a little bit of a long agenda, but hopefully it comes together for all of you. Now, I know from teaching professionals my entire life that the real knowledge is not with me. The real knowledge is in the room. It is with you. So I would love you to interrupt me, to ask me questions, to come in when I say something that's totally off the wall, and say, well, no, in my country this does not apply in a way that you are talking about at all. So please do come in. There is nothing worse than talking for 2 hours to a room that is just sitting there. And those of you who know me from teaching before, you know that we nearly always have a very lively, interactive class. So please do interrupt me, ask questions as we go. Don't wait. Just interrupt me, raise your hand and ask. Because, as I say, as a teacher, nothing is more boring than just talking for 2 hours. No, right, Matt? So, anyways, so there we go. Before, I always want to define what we are talking about first. What is affordability? How is it different from need? How is it different from demand? Demand and affordability are not the same. And people use these terms interchangeably, but they are very different. Affordability is just that. It's the ability to pay in relation to household income. So a ratio of housing-related cost to household disposable income. That's affordability. It's not demand. What's demand? Demand is willingness to pay. I can have enormous need. I know what my affordability level is, but I may not have demand for the certain types of housing that I'm building. I may not have a willingness to pay by the population. And we see that a lot in emerging markets, where the needs are enormous, affordability is low, but we don't have demand for housing, and therefore we have an undersupply. The IMF takes 30% of disposable income as a measure of affordability. And that is what many countries actually do. I think it is at the moment rather low. Sorry, when you travel long, you are always dry, so you have to drink. That is 30%. In some countries, the authorities allow for the mortgage market to go up to 40%. In the United States, for capital market funding of the mortgages, we are allowed to go to 43% of cost, housing cost, relative to income. But for emerging markets, I would certainly stay south of 30%. The other thing that we need to really be very careful with is that affordability decreases as a percentage of income with the income of a country. So affordability in Tanzania would never be higher than 25–30% of income, while indeed in the United States we can go up to 43–45%. So that relationship is important to understand. There is not one measure of affordability. So the IMF takes 30% because they have to do something that is globally viable. But be assured that it differs very much with GDP of the country. Affordability of home ownership is often measured as the house price relative to income. And when we have housing markets that work reasonably well, meaning that if the demand for housing is high, the supply actually comes into the market, we call that an efficient housing market, then that house price to income ratio should be in the order of 4 or 5 times annual income. In many countries, it's up to 10, sometimes 20 times. So I have a few slides to show what has happened to affordability across the globe in recent years. The 0 line, the 100 line, it is an index, so we start at 100, is from 2015. So you can see everything above that mark, do I have a pointer? No. You can see it easily, right? From 2015 to 2021, the affordability level has gone down enormously. Or in other words, the house price to income has gone up dramatically. The house price to rent equally so. So we have seen enormous inflation or erosion of the affordability levels across the world. And that's a problem. When you have to supply your population with housing and the affordability level is eroding like that by way of the price to income, The challenge to provide housing to the majority of the population is enormous. And that, of course, is particularly the case in emerging markets, where incomes are already low relative to formal housing, and where we therefore see that the informal market keeps growing. And we can't quite get rid of informal housing. And that has a high cost to the environment. It has a high cost for humans because of the lack of services. So I'm not at all a romantic about slums and informal housing. It's bad. It's bad on all accounts. So this, you can see how this is working out. Any questions on affordability versus demand and so on, so that we all talk about the same thing and also know that affordability has become a real big issue. So I want now to go to the challenges that we are facing, the big challenges of this moment in time. I want to focus on the macroeconomic, financial, and the trade conditions first, and then go to the global, to the climate challenges that we face. But let's first start talking about the tough macroeconomic conditions and the impact on housing affordability, and how the channels work through which that plays out. So the macroeconomy is, of course, particularly impacted at the moment in all of our countries. I think for the first time, we are all suffering the same. Emerging, advanced economies, we all have inflation. And inflation and housing are making very, very poor bedfellows. It is always very difficult to serve the people in the housing market when you have high inflation, simply because we have to somehow figure out a way to make long-term loans, because housing is so expensive relative to income. We have to have finance. We can't just, buy housing from our pockets. We have to have finance. To do finance in an inflationary environment for a long time is a challenge. So, and here we see that many central banks, just about every country I work in at the moment, the central banks have increased the interest rates, not just with a bit. Look at this graph. This is really, and the light colored are the emerging markets. So the increase in interest rates in emerging markets has been really dramatic. And that is very difficult for housing finance because it drives up the cost so much. So the pandemic easing was great, right? During the pandemic, nearly all central banks cut interest rates. They made special provisions for foreclosure. They eased up the housing market. And then many countries, when the pandemic was over, had to start, because of the inflation pressure, had to start increasing their interest rates. Some countries saw this coming very early. And in this graph, you can see that Latin America, which is that yellow line that goes up there, they understood this very early. And of course, it was Latin America because Latin America has a very long history of inflation. So they immediately understood easing is fine, but wait a minute, we have to start clamping down. So they were way ahead of the curve from all the other countries, Europe, US, and so on. But eventually everyone began to increase the interest rates. So, and that then caused the problem in the housing market. At the same time, and as a consequence of the same movement, we have sovereign bond yields increase, of course, in that environment. That means that our debt in all of our countries is more expensive to service, of course. What it also means is that, and from this figure that I say here, this is IMF figures, they estimate, particularly in emerging markets, that servicing the debt is to rise to 28%, of GDP. So we are heading for enormous trouble with over-indebtedness, more expense of that debt, and therefore enormous fiscal stress on the budgets, particularly of emerging markets. But take our own, the US, very rich country. The battle in Washington about the budget and the servicing of the debt is enormous, and for the right reasons. We also, in the rich countries, face debt servicing problems. So that fiscal tightening is real. So countries, at the same time that they experience need for housing that continues to grow, have very little fiscal space to help with the affordability problems that I just showed to you are escalating. So we have this escalation of affordability problems, that people cannot afford housing increasingly. At the same time, our fiscus, our fiscal part of the economy, cannot support affordability by way of subsidizing, providing free infrastructure, land, whatever. So there is a growing stress in the housing market. Also, when we have very high sovereign bond ratings, banks, particularly in emerging markets, but also in advanced economies, what they do is not make loans to people, certainly not for 30 years, for 20 years, for 15 years. They can sit on their behind, sorry, this is all of you, investing in sovereign bonds because they give such a wonderful return. Why would you go for risky long-term mortgages when you can make a nice income from investing in sovereign bonds? An enormous tension in the market that we cannot underestimate, and it makes it very difficult, particularly in emerging markets, to get the housing market going. All right. This slide I don't want to talk about very much, only to show that GDP growth is under attack. This is also bad news for us. This is a tough environment. This really is tough. But look at what we have here. This here is the United States, the Euro area, and China. This is emerging markets, mostly. And this is the total of economic growth. So what you can see is that China is still projected to be very important as an engine of economic growth in the world, but that the total pie has shrunk. The total GDP of the country, of the world, is far less indeed. And that the United States and Europe are relatively small compared to the economic growth globally that China and emerging markets are providing. We should always keep that in mind. We are a small over here, small piece of the pie. Overall, we are not growing as fast. You can see that in, no. Can you all see that bar? The total growth is down. Then we have what we call, in a fancy term, geo-economic fragmentation, meaning we are all fighting at the moment. And that doesn't help anyone. So we have China protecting itself. We have the United States being more and more protecting, providing subsidies to its industries. So we live in a world where instead of having open markets and flow of goods between all of the blocks, we are seeing protectionism, and that is costly. That makes all the services and goods much more expensive. Why is that bad for us, and why do I even mention that? Because it impacts immediately the price of housing. Certainly in emerging markets that have to import a lot of the materials that go into house construction. So the effect on the cost of construction is really noticeable by this trend that we are finding ourselves in of protectionism. We went through that. Those of you from Latin America, I don't know how many people are here from Latin America, you remember your import substitution model and how costly that was for your economies in the 90s, 80s and 90s. We are not quite back to the same, but we are heading in the wrong direction. And it is noticeable in the price of materials. So then we have a net outflow of resources away from emerging markets. And that is also a problem, particularly for emerging markets. So the outflows in recent years out of portfolio investors and so on, out of emerging markets has been rather dramatic. What does all this macroeconomic, actually rather bad news, I don't have that much good news on the macroeconomic side, unfortunately, what does it mean for housing? I know this slide is a bit of a challenge for those of you far away, but I'm sorry, I like to have all of these factors.
We will share the slides.
Right.
Everyone, so I mean, you will have all the material
Yeah.
after and a nice certificate.
Right, I'm
So
sorry.
I'll give you all the material after.
Which row can see it still? Well, depends on your lenses. Oh, not so bad. Not so bad. Okay, good. All right, what I'm saying there. This macroeconomic picture is particularly bad because mortgage interest rates are increasing. Very difficult for the market that we are in. So that reduces the demand for loans, of course. When interest rates are very high, people try to wait and postpone buying a house. They can't afford it, whatever the reason. So demand goes down. The impact also is big on the supply of loans. I already mentioned, first of all, bankers have very good alternatives to invest their money in that make their money risk-free. Why would they go for risky mortgage lending? So the impact on supply of loans is impacted. That is particularly in fixed-rate mortgage environments because these portfolios in fixed-rate mortgages run losses, of course, in this inflation. And we have a reduction in long-term fixed-rate mortgage loan originations. Lenders do, in this environment, not make fixed-rate loans unless they can hedge the interest rate risk. If they don't have a measure to hedge interest rate risk, like Denmark, the US, then they don't write long-term mortgages, of course. So that interest rate risk impairs the banking sector from making a lot of long-term loans. Then we have the danger of default growing, and we see that in the UK at the moment, on the existing adjustable rate portfolios. Because at one point, these babies have to be repriced and have the incomes sufficiently increased with inflation to make that repricing affordable for people. Normally, in the long run, incomes do go up with inflation. In the short term, they don't. And so we have a short-term problem in many countries where when we reprice our portfolio as lenders, we may see a lot of defaults coming in. So that is the very on the adjustable rate part of the portfolio. So we have different fixed rate and long-term rate issues in this inflationary environment. Then we have effects on house prices relative to income. In advanced economies, the increased interest rate often normally lead to house price decrease. So normally, in normal markets, when the interest rate goes up, house prices come down rather quickly. And again, that we do not see so much, particularly in fixed rate environments. Why not? If I sit in a house and I have a 30-year loan at a fantastic old rate, I'm not going to sell, so I'm not moving. If I can help it at all, I will not move. I'm sitting in a house like that. So you are not moving. That means that the supply of existing houses in the secondary housing market is very constrained. That is the situation in the United States. So we have no trading in secondary markets. It is terrible. Yeah, Anna.
Okay, last week The Economist had a very interesting article on the American situation as you're describing it. And I want to ask you, do you think it will lead to any changes in the US and in which areas and how?
Well, we may consider the 30-year mortgage at the same time that we should. But at the same time, it is so much, like a bit in Denmark, the bread and butter of our society. That was a promise made after the Second World War, first in the Depression, when all these secondary market institutions were set up in the United States that allowed lenders to sell their mortgages in the secondary market, subsidized by the US government. Our whole system, of course, is subsidized in the US. We don't want to say it ever, but that is what we do. And that has become like our birthright. I say us. I know that I'm still not a citizen, so I'm still Dutch, but that is the case. So there will be changes, and this lesson that we have seen, and that is ongoing, that we don't move the secondary market, that it is stuck, and that it has enormous price effects. If I don't have supply, you know, I could expect as the Federal Reserve, if I now talk about the Federal Reserve, should I increase the rates further? Is the economy slowing down or not? Can I stop? I mean, all these decisions are on the table at the moment. And a lot is driven by the housing market. If I do not have a housing market that responds in a normal way to my macroeconomic indicators, I have a problem as a Fed. And that is what the discussion at the moment is. So the Economist article, I know it well, only talks to a small part of the decision-making. The other part of the decision-making is at the Fed, how the housing market influences the Federal Reserve. So this is the problem in the US. We have an enormous supply constraint that keeps prices up, even though the Fed is increasing the interest rates to get inflation down. But inflation cannot really get down if my housing cost as a percentage of income doesn't decrease, and it won't decrease because of the stickiness in my existing housing market. Everyone clear on that issue? So, yeah.
This is a very important point.
Yeah.
The decision of the Fed have an indirect impact also in our housing market.
Yeah.
I was discussing with the governor of Central Bank of Hungary. So if we are relaxed and we're going to increase interest rate, of course, there is a currency problem, and we pay all our importation in dollars.
Yeah.
So, I mean, actually, the inflation is coming from back door if the Americans are going up. So, I mean, it's a bit a trap for the ECB, who is taking the best decision, but not increasing rates can have an impact on inflation as well, because if the Americans are increasing the rates, this will come. And our petrol, which is the most expensive good in our, it's coming and paid in dollars. So, I mean, just to...
No, it's so I want you to see in advanced economies where most of us who buy a house have a mortgage. Not all of us, but most of it. I mean, some people can pay cash for a house. I don't know how many of you in the room can just do that, but not many. So we nearly all have mortgages. So this, in advanced economies, this link to the macroeconomy is direct. And at the moment, increasingly problematic, particularly because of the fixed rate environment. In emerging markets, and that is why I split up the situation, we don't have that problem. We have a totally different problem. We have a tiny percentage, and I put emerging markets, developing economies together, which of course is ridiculous because they are so diverse. But I have to have something that we can get a handle on for this lecture, no? I can't differentiate it all. But in emerging markets, a tiny fraction of the population has a mortgage. So the mortgage sector doesn't impact, and therefore the housing sector doesn't impact our macroeconomy in the same way as in advanced economies. Totally different, because that link through the mortgage market doesn't exist in the same way. Everyone clear? So what is the problem in emerging markets then of all of this macro stuff? It is that we see price increases because the mortgages that we have are very highly priced. We have to import under inflationary conditions our building materials. So the price effects on my new stock are enormous, enormous. I work in Egypt, Uzbekistan at the moment, the Dominican Republic, you name it. I cannot make it work in the affordable. My field is affordable, those of you who do not know me. But I work on affordable housing. That's my job. Well, I can tell you one thing.
When we speak to the developer and we speak about green housing,
Yeah.
on top of this, what you are saying...
I come there.
Oh, yeah.
I come there. 1 second. So we have enormous affordability problems in emerging markets. It's not guided through the mortgage market, as long as we all understand that. Not at all. Very different. But because affordability incomes lack inflation, particularly in the shorter term, like year, 2 years, we have an enormous problem. And I cannot make the numbers work in Egypt for it. There's just no way, all right? So then we already spoke about this. The effects on the fiscal space are enormous. Low tax revenue, we have no decreased income in the treasuries of countries, and we have therefore no room to subsidize this affordability problem. Everyone clear? Yeah.
Jump in just.
Yes, please.
How do you factor into that analysis the fact that in emerging markets these fixed rates and loans are not that prevalent compared to the advanced economies? So this is more like variable interest rates environment in emerging countries.
Fortunately for you, otherwise many of your institutions would have gone belly up. Had you no adjustable rate loans, it would have been much more difficult. For instance, in Egypt, anyone here from Egypt? In Egypt, in the Constitution or the Bill of Rights of Housing, there is a clause that you cannot write adjustable rate loans because that is not manageable for poor people. They cannot deal with adjustable rate loans where 1 month you pay 100, next month 150. So it is there forbidden. So these bankers have to write fixed rate loans. How the hell do you do that? No capital markets to speak of? No, I mean, impossible. Do we stop with the little mortgage market that we have, writing loans? You bet. No one makes a loan in that environment. Everyone clear? But in other markets, of course, everything is adjustable. India, other markets, because there is no way without access to capital markets that you can fund a fixed rate portfolio in these environments. So that is a problem, yes?
But we are always facing the positive aspect of long-term fixation, but it also comes maybe with the drawback of having dampening the monetary transmission. And
of course.
Take away the power of the central
bank to
the macroeconomic situation.
And that is precisely the point that I'm going to make. In emerging markets, the point therefore, and we are going to go there, is that we have to find mechanisms to fund our mortgages not from the deposits, which have to adjust in the short term to be competitive. You have to fund your deposits. You have to fund your mortgages from your deposits, but the deposits have to increase and decrease on how much interest rates you charge on these things in the shorter term. So you can only write adjustable rate loans in those environments. So the transition in emerging markets has to be on greater access to capital markets, where we have investors that can deal with that interest rate risk that you cannot handle as a primary institution. So we are going there. So that is the link with capital markets, of course, that we are going to. Affordability and so on and so forth. Through all the problems, we come back to that. So now I want to go to and make the link also with the second part of the presentation this morning to climate. And all of you, I don't know if you feel it, but I find climate right now in this room, you know, very, very hot, very sticky, because we are skimping on air conditioning, obviously. But it has been hot this whole summer. So I'm going to focus on climate and housing and the impact of the housing sector on climate and housing affordability. And then to see the role that housing can play in reducing climate risk. So housing plays two roles. It's bad for the environment, but it can also be good. So that's where I'm going in the next 5 minutes. And then we bring all these pictures together. So climate change related risk. First of all, we see, of course, as you all know, by just every day going in the newspapers, the frequency, scale, and cost of disasters, climate-related disasters, and the cost it particularly has on the housing sector. The housing sector, of course, is by far the largest component of the built environment. So if we have fires, floods, earthquakes, you name it, typhoons. I just came from the Dominican Republic. We were for 2 days stuck in our hotel because of yet another hurricane. The costs are enormous. In particularly the housing sector, not the office sector, not the industrial sector, the housing sector. So, and that growing cost and human suffering, of course, is in our face all the time. We have global warming causing now increased population displacement, again, impacting the housing sector most of all. And the cost of, this is an IMF estimate, for the near future, we are talking now, is between 9 and 4% to deal with this of GDP, of taking care of this climate-related infrastructure problem. But look at the graph, the frequency and the economic damage. The economic damage, for those of you in the back, is the blue bar. The frequency is orange. You can see this is not funny anymore. This is serious stuff. So on the property side, we have direct risk on the property, the cost of this climate change on the property sector, but also through what they call transition risk. So those are the policy shift, changes in consumer preferences, and so on and so forth. They have direct effect on households, the business community, and so on. They also, and that is another transmission channel, enormous impact on lenders, on insurers and investors that invest in the housing sector. So insurers, I don't know whether you follow the US at all, but the last week, a few days ago, the insurers in the US, house insurers, home insurers, have just decreed that they are not writing insurance, not flooding, no insurance at all for housing in zones at risk. What the hell that means, we will see no insurance policy. If you want to buy a house in these zones, you're on your own. Very nice. What is the impact of that? What is the impact if I can't insure my house? Come on, ladies and gentlemen, housing experts. Sorry?
We will be less willing to buy.
Exactly, and therefore,
Inshallah.
if we don't buy, that means that the demand for housing in these zones is going down, that the price of these houses are, of course, tanking. Yeah? If these houses in these zones had mortgages, prices are tanking. Now what, bankers? Now what? My price is tanking. We have a mortgage against that house.
Yeah, they are losing.
We are underwater. No demand for these houses because insurers have pulled out. So what the hell do I do with my mortgage? If you default, you can't even sell, right? At the right price. So this is serious stuff. This was just last week. Just last week. Just one little thing I'm mentioning, and that is all that loop. Very important. So the potential impact on the economic sector and the financial stability of our mortgage sector is not trivial. It is going to really be big. It begins with flood zones, but it will not end there. So I don't know whether you know CERES, no? This climate NGO. I will not dwell on it long, and you cannot read it in the back anyway, but they keep a scorecard for the industry. And it is a very interesting group. It's neutral, and it just scores what is happening by way of climate change on our sector. So they have warned about this financial risk that the housing sector or the financial sector is beginning to pose on our whole financial system. And they warn that the central bankers amongst us, are there central bankers here? No? Anyway, they should be here because the regulators...
They are here. They are shy, but they are here.
Central bankers amongst us, then, you should be careful. Central bankers, according to this organization, are really not paying attention to climate risk relative to the housing risk and the financial risk of the entire financial system. And that is what everyone now, gradually in the United States, begins to warn about. There is some progress in advanced economies, very little attention by central bankers in emerging markets. They feel climate has nothing to do with them, but it has, unfortunately. So, anyways, there is also minimal attention paid, according to this NGO, on the climate risk-related concerns for the affordable community. Now, when I look at residential, on the flip side, I call it concurrently, when I look at the built-up sector, the housing sector, and how much it itself contributes to climate change, that is the flip side, of course. The housing sector is influenced negatively by climate change and poses bigger risks, but the housing sector itself is an enormous transmitter of CO2 and all these other nasty things. So when we look at these graphs, the buildings contribute 37%, they say, but Matt will talk about that, I'm sure, of global energy consumption. The residential buildings are by far the biggest part of all the buildings. Offices and others, neglectable. The residential sector is it. So it uses 28% of total energy and 17% of total CO2 emissions. That's big. The residential sector is a problem, because of population size and growth and urbanization in emerging markets that are growing enormously in their housing sectors, this is going to be an enormous contribution to climate risk. So here we have the figures. You can look at them when you get so that you know I'm not making this up. Even is what they're saying here in this United Nations report. Even if we get buildings that have zero emissions in a couple of years, because of the sheer size of the increase of the housing sector, we cannot do much about that contribution, the total contribution to climate problems by the housing sector. So that is the bad news. What if we don't do anything about making our stock more CO2 friendly? It's even worse then. So that is what this slide is saying. Okay? So no matter how hard we try, because we need so much new housing coming in, we cannot avoid this problem. anymore. So we better do something, no? Is the conclusion. When we now look at the enforcement system, which countries have actually good climate-oriented, housing-related regulations on the supply side? And where are these regulations made? So that's a question for you. When I look at this picture, I see that the countries that are growing the fastest, here, have no regulations on climate efficient housing at all for the supply side of housing. Also, you all know, where are building regulations? They're not at the central government. Who holds the regulations of the building regulations and the permitting and stuff like that? Where is that located in each country? In the bloody local governments. How the hell do I get 6,000 municipalities to do climate-friendly changes to my building regulations? In Nairobi, where I worked for a long time, the building regulations were under the medical officer of health. I mean, honest to God, I could never get any change through the medical officer of health. So the enforcement of building regulations is a mess in most countries.
I think that our friends of the European Commission share the same problem on energy efficiency, which is managed by regions. I think on top of housing problem, we have also the energy efficiency competence.
It's the same.
It's the same kind of...
So this is not so easy, ladies and gentlemen, is all I'm saying with this slide. This is trouble when we look at it globally, but when I drill down on each country that I work in, for instance, that I know how big that problem really is, you know. All right, so climate risk. I have a terrible slide because I want to fit it on one page. But what are the consequences for housing? First of all, increased housing stock at risk. And that has implications I just mentioned on the financial system. It really transmits in the financial system, in the whole climate system, and so on. Very high cost of retrofitting the existing stock in advanced economies. And we have to figure out who is paying for the retrofitting of existing houses, okay? Then very high upfront cost of CO2 efficient new construction, whether I'm talking emerging markets or advanced, it's costly. We have just priced out, again, I just come from a few emerging markets. Egypt, I have the exact number. It's 10% more expensive to build an energy efficient house. Affordable, only affordable. I'm not talking fancy stuff. I'm talking affordable housing in Egypt, 10% more expensive. So who pays for that? We are already struggling to make this growing affordability problem, lagging incomes relative to the cost of housing, to make it work. And now on top of that, I have to do climate friendly. Who pays? You know, it's a big issue. So this is particularly important in emerging markets. Then we have this whole complex enforcement of building and planning. And here I want to focus attention on this one. We already talked about local government and the mess. I want to talk about this for a minute. Climate friendly doesn't only mean your construction cost. Climate friendly means location even more than your construction cost. If I build housing far away in the meadows somewhere, because it is less costly, because the price of land is lower, what the hell do I do? What I do is make transportation cost, energy cost related to transportation, the cost of endless traffic jams. I don't know about your countries. In the countries I work in, it is nearly impossible. Go from one side of Nairobi to another side. Anyone done that recently? It takes you half a day, no? Unbelievable. So when I talk about friendly for the environment, I talk more about location than actual building construction cost itself. And we should never forget that. And that location piece is even more difficult to do something about than getting eco-friendly building materials. Everyone clear? Everyone disagreeing with me? No? You all think it is an enormous problem. Have you lately been in Cairo? I mean, you cannot even drive, you know. You can better walk in these environments. These are the impacts of climate on the housing sector. And the other way around, the impact of housing, location on climate. This is serious stuff. Okay, now I'm going very fast, because otherwise I will... No, I'm hopefully doing well. Yeah, I'm good, you think? Okay. All right, so now I want to put some meat on the numbers. I've talked about advanced and emerging, as if these two worlds are different in their level of development and nothing else. Unfortunately, they are not only different in their level of economic development, but demographically very, very different. So while we have increased problems because we have underdeveloped mortgage systems and so on in emerging markets, we also have terrible numbers of population and household increase. So that makes the problem much more difficult to solve. So here, I hope the back of the room can still see, but let me explain. Forget about the bottom. Look at the top. The top is the population pyramid by region, total populations. So this is the total of Africa, and this is the population pyramid. Everyone understands population pyramids. So these are age groups, right? And so if your bottom is very big, you have a lot of new households coming into the market. If my bottom, this is the 0 to 5 year group, 5 to 10 and so on. So if my bottom is small, I have far fewer households coming in. Households equation here, same as needing a new house. Huh? Household formation is really my need for housing. So what do we see here? We see Africa and Asia having enormous populations, but very young populations compared to very aging Europe, Latin America already fully done, North America, that is Oceania, that is so small. They have so many other problems, I don't even want to talk about it. So we see those figures playing out. So we have to focus on Africa and Asia. When we talk about overall requirement for new housing, right? It's not in the other continents, it's in those two. When I look at the total population figures here, you can see sub-Saharan Africa growing, as we just saw, enormously, much faster. India second, China is tapering off because of the one-child policy, and so on. But sub-Saharan Africa is in trouble, no? Oh, it's good. A large population also means that you have the people to make your economy grow. It's not all bad. It's just a challenge for the housing sector. That's all I'm saying. When I now look at urban compared to total, we can see that sub-Saharan Africa, which is still only 40% urban and urbanizing at an enormously fast rate, will grow their urban population enormously. India too. We see these countries needing, therefore, a hell of a lot of new urban housing. New urban housing is expensive. To build it economically affordable, very difficult to do. So when we now look at countries like the US, Japan, Europe, look at it. Piece of cake. We are fully urbanized. Look at this graph. Fully urbanized. We are not urbanizing anymore. It is sub-Saharan Africa that is still not even 40% urban, and that has a way to go. So think about these figures, and then overlay this with this concept, that these countries are now urbanizing at a much lower GDP per capita than when Latin America urbanized, than when Asia urbanized. Very, very different. Now, the countries that are urbanizing, like the regions that are urbanizing, like sub-Saharan Africa, do so at 1,500, 2,000 GDP per person. Look at the countries that are now already 50% urban and how low an income per capita per year they represent. So this brings me back again to the affordability problem. So we have low incomes because, relatively speaking, also into the urban area is coming this wave of rural migrants that are very poor. So the base is growing at a low income. But most of these people are employed in the informal sector, and the tax base of these cities is therefore very, very low. Everyone clear? So now with the stress of national fiscal budgets and everything, it's very difficult to provide affordable housing for this growing urban population. Everyone sees the tension. Who is paying for this? Why? You can see from this graph the slum areas and squatter areas growing, because who can afford to buy formal housing when you have this picture? Yeah? Any questions on this? This is a difficult situation, and particularly for Africa and South Asia. So again, I summarize my demographic here. This is the summary slide, but it has slightly larger font, fortunately for you in the back. So we have a young population and rapid household formation in Africa and parts of Asia. Not all, but a large part of Asia. It is still, these countries are still urbanizing, India too, at a very rapid rate from a very low base. So increasing urban populations is the issue. Europe, parts of Asia, the aging part, are very stable demographically. So no big, in the US, if I am a developer and I build 1,000 housing units project, I have a big project. You know, Toll Brothers will be very proud of that. It's peanuts in Asia. What do you do with 1,000 houses? I mean, you know, it is totally different. So US, Latin America, and so on, also mostly urban. So no stress on the demographic side. So the consequences for the housing sector, new construction versus upgrading particularly, there is an enormous need, and we mentioned that before, for large-scale, new, urban, and green housing. We have to build green. We have no choice. We showed that in the figures. It's already bad enough. In Africa and South Asia, but we have very low affordability, particularly in urban areas. We have to focus on retrofitting in stable and slow growing, including Latin America. Latin America is in much better shape because it is not urbanizing anymore very rapidly. So it can get a handle on the housing problem, while that is very different in the other continents. So we have a different orientation. New construction in large parts of the developing world, mostly retrofitting in other parts. Any questions on all my basic framing problems? Macroeconomic, climate, and demographic. Everyone clear on where that leaves us? It's not an easy picture anymore. It might have been easier a couple of decades ago, but no one listened. So we are still now here with growing and growing problems, no? So we have to address that. Now I come to why we are here, why we are all going to spend all this time together in these few days. Because my thesis is, and so is yours, I suppose, that housing finance can actually be, or must be, the catalyst to solve the problems. And I will show you why. So, first of all, the housing sector cannot be ignored. We already spoke about that it is the largest part of the built environment. So from a climate perspective, we are all clear. But now from an economic perspective, it is an enormous part of GDP. The housing sector, and I have the next slide to show that I'm not lying, is 19%. Just before COVID hit, I take that figure because otherwise the figures are a bit weirder. 19% of GDP is made up in the United States by the housing sector. How? It is particularly consumption that drives it. So consumption, the housing services we call it, rent, imputed rent, the whole lot, is 11%. Operation is 4.5%. And then we have investment, which we as housing people are always focused on. We only focus, when we talk about the housing contribution to GDP, on how much we build. Now, we build very little in Europe. Housing is an enormous part of our economy through consumption, all right? So we have therefore a total of 19%. So the housing sector is a barometer of how well our economy does. That's why the Fed, when they raise or not raise, they have the housing sector in mind. Nothing else much. It's the housing sector. Everyone clear on that? So now you see the figures, where that is so. Also, it is a large part of the wealth of people, of households, 50 to 90% of wealth. It creates enormous jobs, 5 to 10% in the building industry, and so on and so forth. It also is an enormously important part of local revenue, if you can build in the formal sector. If not, it is a drain on your economy. If I build in the formal sector, I can tax. I have property tax. This is the good thing. Efficient housing finance stimulates the financial sector. It stimulates capital markets and so on and so forth. So we cannot not take the housing sector seriously. It is too big a part of our economy. Here I'm not going to talk about much, but because the figures in developing economies are so poor, because so many people build in the informal sector, it is very difficult to have figures that I showed you for the United States for a country like Tanzania or Kenya, because I have a whole sector that's not included in the official statistics. And while central banks make an effort, it's very difficult to get those figures. We did this exercise for 11 emerging markets recently in a study that we did. First of all, I want to say there is such a need for better data. When you go into the data, and I just want to understand what proportion of the housing sector of the GDP is coming from the housing sector, it's nearly impossible in emerging markets. It's terrible. The data are not there. And it's such a big sector. The short of it is that exercise of 11 emerging markets showed that the contribution of housing to GDP was roughly between 14 to 16% if I took the informal sector into consideration. So, in other words, housing is just as big in emerging markets as part of GDP as in advanced economies. Okay, so this is important to begin to understand. But housing finance can be a catalyst to develop green affordable housing. So I know that I have to pay attention to my housing. I know my numbers. I know my household growth. How do I get there? How do I provide green buildings in emerging markets with low incomes? I cannot do it without the housing finance sector. I can show you all the data on how important part housing is of GDP. It doesn't help me one bit in getting green, sound, affordable housing to be constructed, not informally. For informal, we cannot have green housing. I have to have formal housing in order to comply with green regulations. I have to do that through the finance sector. So housing finance can create instruments to deal with the macroeconomic and climate risks of the housing sector. So it can take care of the interest rate risk that we talked about, the liquidity risk we talked about, a little while ago, the credit risk, the green lending and investment products. All of that can be taken care of through instruments and innovations in the housing finance sector, not the construction sector per se. Why do I say that? Because developers only build for market segments that can be financed. So I can have all the green standards that you have to build, like according to those standards, to be zero emission, whatever. I can have all those standards. Now what? Who's going to build that and buy that? If I don't have finance, my developers are not coming into that market. So I have to have the housing finance sector, I call it, as a catalyst to translate that need, hopefully demand, into actual products. And developers only go to a market segment that can be financed. If I have a large part of the economy or the people working in the informal sector who cannot get a loan from the banking sector, developers are not going to build for that group. It's as simple as that. If green standards are too expensive, developers will not build them. They will build in violation. You know developers. Are there developers in the room? Sorry about that. Outside. So I will be lynched by the time. So developers are practical people. I like them. But you have to give them the right incentives. And they will not build for segments for which there is no end user finance, meaning if they cannot know that there is a client for their housing when they finish the buildings with a mortgage or cash, not affordable, so a mortgage, they will not build for that segment. Yes, ma'am.
I was just wondering, because that's truly how really, if we look from the bank's perspective, because we want to finance green, but the challenge is that the incentives have to come for the customer, because the bank cannot say that, okay, I'll finance only green. So it comes kind of like the motive has to come from somewhere else. And I mean, trust us, we'll finance green, no problem with that.
That's right. No, but that's the problem. It is a big problem. And we have to figure out a way to deal with it. Because otherwise we don't get green. We don't get housing that is affordable. So, what I'm saying here is that these developers need project finance that can be sourced, but particularly offtake finance, so that at the end they can sell to the people, move on and build more. That's their business model. No, it's very straightforward. So, large housing deficit alone, I showed the population figures in sub-Saharan Africa and Asia, enormous large housing deficit figures. That doesn't mean a thing that I have 1 million backlog or 5 million backlog. That pent-up demand, as they call it sometimes euphemistically. It doesn't mean a thing if it doesn't create a market. There will only be a market for affordable housing when there is ability to pay. And therefore, when I can serve the mass of the population with finance. Poor people cannot pay from their pocket. You and I maybe, yeah, we can buy cash. Not poor people. They need finance. So there is no market for affordable housing without finance for lower income people informally employed. Green standards alone, I can have all the green standards in the world. They do not create a housing market. Green standards tied to finance products and investment products, they create a market, not the other way around. I need to have both. So I need finance to begin to move this market size-wise, green-wise. So the consequences create green and social lending and investment instruments for global application. We need that very badly, and we are on our way, and critical to expand access to finance, particularly in emerging markets. That is the conclusion of what we have just discussed. Everyone clear. Now I go and split up. Are you still holding out without coffee? Yeah? You can still do it?
They all voluntary for this, so
You
can suffer a bit.
Yeah. You volunteer, that's right. All right, so then I go, I will try to be fast and get to the core messages. I split now up the how-to part of this lecture in advanced economies and emerging. Because as we have now understood, these are two very different universes. I cannot talk global climate stuff forever as if I have one universe. It is just not productive. And therefore, I really have to see what it means for advanced economies first and then go to emerging markets. And emerging markets, part of emerging markets belongs to advanced, but I leave that up to you to make that distinction. You all know that. So, advanced economies. You have a very sound infrastructure in advanced economies. You have capital markets supplying long-term funds. You can securitize. You can have covered bonds. You can access capital markets directly if you so choose. You are in good shape. You can write fixed-rate mortgages. You can even subsidize your population who cannot afford to build green. You can do that because you have the money and you have the tools to do so. So advanced economies are in really much better shape. You also have made, and we all have in recent years, made underwriting of mortgages a lot better. Because we learned from the mess that the US particularly, not only, let us be fair, let me have the two hats of my Europeanness and my US, background. We all created a mess in the mortgage market during the global financial crisis. Granted, the US more than anyone else because of the securitization stuff and the wonderful fraud that we did, but we learned our lesson and we have much better underwriting systems. We have much better systems on our books. So we know how to deal with first-time homeowners in a much better way. We have large mortgage sectors. Over 60% of GDP is what the size of the mortgage market normally is. We have more than roughly 40% of homeowners carrying a mortgage. Look at this. You cannot see that in the back, but the gray bar is people with a mortgage. The percentage of homeowners, to be precise, with a mortgage. So it's large in advanced economies, many old people, of course, have paid off their mortgage. Paying off the mortgage when you have an adjustable rate and the rates go up, very common, but that is roughly the figure. The share of mortgage debt in total household debt, roughly when you have a mortgage, it's upward from 50% all the way up to 70% of your total debt. So households know how to do mortgages, they have mortgages, all of that is very much understood in advanced economies. So the response to the macro challenges that you see at the moment in the macro economy, in advanced economies, are different. Those countries that have the funding predominantly come for mortgages from the capital markets have a different problem than those advanced economies that fund the mortgages mostly through the deposits. We talked about that just a minute ago, so I can skip this. It's very fast. So if you can finance your mortgage portfolio from the capital markets and you get long-term funding from the capital markets, you can write fixed-rate mortgages. Simple. And so the more you can do that, the better it is for your households, because they like a fixed rate, or at least fixed for 7, 10 years, whatever. Okay? So that is one group of countries, and that is very good for the clients, and it reduces, of course, for the lenders, the credit risk. Because adjustable rate loans always have a higher risk that people cannot pay when interest rates go up. So my credit risk stays nice and stable. So we have limited house price effect. So we want to look quickly at the adjustable ones, the deposit funding. They have to be adjustable rates, or fixed for max 5 years, I would say, in most markets. So, and that is another large group of advanced economies. But the adjustments work differently through these different models. What we see at the moment is we have an increasing and beautiful, I think it's very good, mix of funding. We have countries now do deposit funding mixed in with covered bonds, mixed in with securitizations, particularly securitization, very important for these special, like when you go retrofitting, a special part of the mortgage portfolio that goes for that will find investors in a securitized portfolio for those niche markets that are ESG labeled. So we have many tools in advanced economies that relate to the climate risk and the macroeconomic risks. So, in fact, we are in very good shape in advanced economies to do all the right things, you know. So we focus in advanced economies on housing finance that is green. That is, I use the word green. I know there are 100 ways to say it, emission, this, that, and the other. But so we can do this, and there is a growing appetite by investors. And to prove that, I have given you here a few slides to show that there is indeed investor appetite in green. These are Preqin figures, just the latest from August, showing that investors increasingly want ESG-labeled funds. We have this survey that Preqin did to show that investors haven't en masse, just because of the Republican stupidity in the United States, we do not see that investors are so stupid to go backwards that much. So we see that there is general interest in ESG investing. So this is a very good sign. When we look at the MSCI, I just pulled down the very latest information on the funds that the MSCI collects. We see green. This green is green. Thank them for that. So still growing very, very nicely. So even Q2 of we see hardly any shifts, really. So the green agenda, the social agenda, and the sustainable agenda, they split it up, as you all know from the figures, in these three categories. It is sound. We have a lot of new sustainability investment coming in. The sustainability portfolio is a little bit more complicated than green or social, because the sustainability, as most of you in this room I think know, you also have to show that the issuer of this bond, not just the product, but the issuer is sort of green. So it has these KPI, these performance standards on the issuer. So sustainability portfolios are always a little bit more difficult, because they need the product as well as the issuer to be vetted as ESG. So those are some of the figures. Let me go back to the other slide. So that is that part. We see also big progress towards climate policy for finance generally, not housing finance alone. But we see standardization of the principles across advanced economies, the guidelines on the use of proceeds, project evaluation, the management of the proceeds and the reporting. All these standards are coming together step by step, but definitely moving on. So things are looking, I think, very well, very hopeful. We see increasing transparency. We have the European Union new taxonomy. Most of you are familiar with those, and sustainability financial disclosure requirements in the European Union. I think it's now approved in June, July, whatever. In the US, the Securities and Exchange Commission, I think, has just, under a little bit of duress, they get blamed for everything under the sun, but they have their green guidelines, their ESG guidelines. No matter all the political battling, we keep on being on track in the US even. Can you believe it? The data requirements are a main concern for investors and for those who have to prove that they are green. How do they get the data to show that they are actually green? That's a big concern in advanced economies and, of course, in emerging markets. There is politicization, of course, and you can read about that in the newspapers. Vanguard and BlackRock, two big, giant investors, have just reduced their ESG portfolios, but not by that much. 5%, I can live with that. If that makes the Republicans sort of get off your neck, fine. Oh no, this one. All right, lastly, on the real side, of course, we need, for the finance side, to work green, we need green stock. No, that is, otherwise we don't have green investment. If my product is not green, I cannot do much. And that is still a trick. So we have more global standards for green development. Many jurisdictions now develop their own green standards. We are really moving, I think. You know, even India and Egypt have green standards. So, you know, locally, very nice. So we see that all these guidelines of energy efficient mortgages, and the EMF has helped very much with their 2018 initiative. The secondary market, we have these green covered bonds, wonderful. We have a whole policy paper on green securitization. I mean, brilliant. These things are all available and well developed, so I'm very hopeful. And then sustainable securitization with a little bit more complications, but all of that is in progress. So very, very interesting tools. Now, I mention them under advanced economies, but I also mention India and Egypt to show that this is not just isolated in the advanced economies, but a mixture. But because of the large financial and mortgage sectors in advanced economies, the advanced economies are in the lead here. And emerging markets can learn a lot from all these instruments that are developed because of the size of the mortgage market in advanced economies. So there is really a piggy banking backing that can go on here for emerging markets. All right, transparency and disclosure by financial institutions are, of course, the drivers against greenwashing. We all know about that. I'm not going to spend much time on that. Greenwashing is an issue. Before I stop talking about all the good news in advanced economies, one big caution. Those of you, I spoke this morning with someone who had just gone to San Francisco. Very good example of the problem I'm now going to mention as the biggest issue in advanced economies. And that is the not in my backyard problem. The supply side constraint that we face in advanced economies. Many people do not want affordable housing in their municipality, in their neighborhood. And we see, therefore, that we have no supply of affordable housing, not nearly enough supply. And that, in advanced economies, drives up the price of housing. And that is a major constraint. We do not have so much a financial greening. All of that moves on very nicely. What doesn't move is the supply side. And that is a major issue. I have, this graph comes from the OECD, and we can see that markets that are having a liberal mortgage market, but a very low housing supply elasticity, have much higher prices for housing than countries where we have also a liberalized mortgage market, but are very elastic in their supply, meaning that when there is demand, the supply part of the market comes in and builds houses. That is supply elasticity. Well, sort of. So supply elasticity is the big constraint in advanced economies. And we need to be very aware of that. We can talk green, green, green. If we don't get supply, that doesn't help us much. So those are some, this is what I put in an annex to show you the difference, but I'm not talking to them. What is a supply elastic market and what does it do for prices and what is an inelastic supply market, but not for now. I know you need coffee. So, summary on advanced economies. The current macroeconomic volatility is felt in all the markets through the mortgage market, but also through the supply side. Big impact on housing affordability, the added burden of climate change, losses, insurance costs, and the cost of retrofitting of the stock. All have costs that someone has to bear. The housing finance sector is very critical in supporting that market, the green market, the retrofitting market. Without housing finance, that market will not move. The regulatory framework is coming together for green investment, and the cost we talked about is, of course, high, even if we have downstream enormous benefits of a greenhouse that has lower energy costs and so on. We need subsidies to do the retrofitting for a large part of our population, even in advanced economies, who cannot bear the cost of retrofitting their houses. Those are basically the advanced economies issues, but please tell me what I have left out. Feels okay, sort of? Right. Whatever. Let's go to the emerging markets, and that is then the end. So emerging markets, very different. So for housing finance to play the same catalytic role as we have in advanced economies, green finance, all these wonderful instruments, I have to have a housing finance system. If my housing finance system is very small, the housing finance system cannot play a catalytic role. It is as simple as that. So a lot of change, good change, has happened in emerging markets. And as I say, that is my bread and butter. That is where I work all the time. A lot of positive change in emerging markets. Not in all, but in very many. So we see really a good movement in housing finance. But it is still tiny. Now, these are a bit old, but you can see that the size of the mortgage debt in each country depends or is really related to the GDP of a country, for good reasons. We all understand that. Now, these figures are from 2017. I haven't been able to update them, but we are working on it. Nevertheless, the trend is very, very clear. So the mortgages outstanding in emerging markets are still around 10% of GDP, still very, very small. So the top priority in this whole agenda that we are talking about here is to expand the housing finance system. And not just expand the housing finance system, but the access to housing finance by the majority of the population. And those are very difficult agenda items. It is very different from creating a green covered bond. You can sit, create it, go to your investors, is it acceptable, and you move. This agenda is much harder, and that is what emerging markets face. So what are the main constraints in scaling up emerging markets housing finance systems so that they can begin to be the engines of this change to formal green housing? It is the limited access. I have boiled it down. I know those of you in emerging markets are in the room, and you have a whole list of reasons why your systems are small. I have boiled it down to 2, just for this lecture. I need access to longer-term finance. I cannot get there with only deposit-based funding. My deposit base is not large enough. My deposit base is not long-term enough. 2 reasons. I need to get access to longer-term fund. The other biggest problem, two big problems, the other one is I have to deepen my system. I have to make sure that everyone who can pay for a house with a mortgage can get a mortgage. And that is a challenge. So those are the two things I focus on. The particular one that is depicted here, and I will summarize it very quickly, I need access to longer-term funds. And I know in this room, in the covered bond area, we have a lot of people that are the heads or work in a liquidity facility of one type or another. I see Oscar, I know my friends from Pakistan, I know that there are many people here that work in these entities that have been created to access longer-term funding. Has it been successful in all the countries that have these institutions? No, not. It's very challenging, even with those institutions. I have listed a few types of these institutions, from the very simple ones to more complicated ones. So the first and simplest one is when the central bank comes in and say, like in many countries has happened, okay guys, I open up the portfolio for longer-term funding backed up by the central bank, so you can make more mortgages. Actually, this is what the Dominican Republic, where I just came from, has just done. So it permits the direct repo operations to work. The negative side of having the central bank open up, you know, its balance sheet for longer-term mortgages is that it is confined to the central bank willingness to do this. If tomorrow the central bank feels, no, my balance sheet cannot handle this, and it stops, we haven't created a market. So you do not create a market with the central, a little bit of an incentive, but it is not a permanent solution. Everyone clear what I mean here? It's very important that the central bank plays that facilitative role, but ultimately something else has to happen in the market itself. We have this class, and that is the class here that is mostly in the room. Central bank or the Ministry of Finance operates a mortgage refinancing institution. So it sets up a refinancing institution with their own equity. It provides collateralized term finance backed by the mortgages. The refinance institution provides collateralized term finance to lenders on the basis of their nicely performing mortgages, and they in return get longer-term finance so that they can make more mortgages. So common model, very common model, Giacomas in Malaysia, many of the Asian ones, and it can be done by the Ministry of Finance or the central bank. I think you know those models. The other one is public-private, where the banks come in and be shareholders of an institution together with some support from the government, and they do the same thing. They begin to float bonds in the capital markets. On the basis of those bonds, they can provide medium-term finance to mortgage lenders who then can expand more fixed-rate loans and a larger number of loans. So this very common model as well. And then, of course, different from refinancing, you have securitization. These babies go off your balance sheet. They are not refinanced. They are taken off, put in a pool, sell the parts, and you are rid of it as a lender. That is another mechanism, and as I said before, it can be very helpful in smaller niche markets. So those are the most common ways to do to create more funding for the mortgage market and longer-term mortgages, so that indeed the lenders that receive medium-term finance can make longer-term loans, and a lot more of them. I can't emphasize how important it is. When I run the numbers on HOVINET, there is the direct correlation between countries' size of the mortgage market, whether they have access to long-term funds or whether they don't. It is very stark. So that is very important to keep in mind. But not all these liquidity facilities work. I cannot go away here and stand in front of you without pointing out that many do not work well, or have to be totally restructured, not once, but twice or three times. Why? Because these institutions may not have credibility to go to the capital markets and get a very good rate. If I run a big bank in whatever country, I can go to the capital markets on the strength of my own balance sheet and get a very nice rating because my institution is sound and safe. If that new institution's refinancing institution goes to the capital markets, the investors say, who the hell are you? What is your track record? Who are you? And it has become not so easy for liquidity facilities to go to the capital market and get a good rating without heavy backing from from their financial institutions, the government, the central bank, the Ministry of Finance. So the liquidity facility in Indonesia, is it here? No? Didn't go anywhere. It became like a securitization shop. Well, every Tom, Dick, and Harry can securitize. You don't need a liquidity facility for that. So that's not the purpose. You can figure out a way to work, but that's not the one in Egypt. Egypt here didn't go anywhere. It could not get a decent rating to get access to funding at the right price in the capital markets. So to structure these things is not so simple, so that they actually can work. What they did in Nigeria is they set up, and several other countries, they set up a special fund. They said, oh, the hell with the capital markets. The government is going to finance a pot of money, and we just, for the affordable sector, and we finance developers, we finance long-term mortgages from it, and that's how we can start this market. And that fund, the housing fund in Nigeria, did a fantastic job. Nigeria here? No? Did a very good job. But what is the problem with that model? When my money dries up from the government, I have no market. Finished. Now what? So, yes, you can stimulate the market short term, but if there is no mechanism to really make it into a market-friendly, supportive, system, you're not going anywhere. So keep those examples in mind. So liquidity facilities, covered bond securitization can all play a critical role, and particularly in the greening, creating greening instruments and so on and so forth. Climate-related instrument guidelines, regulations, all can be used globally and expand the investor pool for emerging markets. So they can learn very quickly from the advanced economies and do not have to reinvent the wheel. So all positive, but that liquidity funding mechanism has to be sound and safe, and it needs to be set up in emerging markets for them to grow their mortgage markets. And is there anyone here that disagrees with that? That we need access to longer-term funds? There are many people here from emerging markets. I do not see a way out without more access to long-term funds. Okay, so the other part, very quickly, it has many slides, but I will summarize it. And that is that I have to expand access by the majority of my population to the mortgage market. Why? Mortgages are the cheapest form of finance because they're based on collateral of the land and the house. There is no cheaper source of finance. Consumer finance for housing, kiss of death. You can do incremental building, but for growing urban, incremental building has a limitation. I need mass housing. I showed you the figures. I can only do that with finance. So I need people to qualify for a mortgage because that's the only way that I can make this affordable. But people at the bottom, 50% of the population, have many problems. Many are in the informal sector, low savings, negative credit history, non-lienable house or land, fear of long-term credit by that population, all of that. Or many at the same time, right? Everyone in agreement? So we have multiple problems. Here I show you some graphs on the size of the informal market in emerging markets. Look at sub-Saharan Africa, 89% of employment, and this is ILO, this is not me, Hoek, Smit making this up. This is the ILO, 89% in the informal sector. Can I just say, well, sorry, as a central bank, but if you make a mortgage to a person with informal income, I penalize you the hell out of you, really, because this is a risky mortgage, and so you really pay through the nose, through reserve requirement, whatever the case may be that the central bank slaps on. You cannot do that so simply as a central bank. That's not a helpful way to go about it if this is the employment situation of your population. You have to figure out a way to serve that population, okay? So that is the big challenge. So we have all those risks, credit risk, political risk, transaction costs are higher for small mortgages than for large mortgages, all right? All of those costs. The lenders have to overcome, and then we have the regulatory cost. So how can we address those risks and those costs? And I'm now going very fast because otherwise we are getting in trouble. We know a lot of ways of doing it, from subsidies to flexible mortgages. We all know those things. The new ways are beginning to be used more commonly. So we need the default risk to be addressed. We need new technologies to service these loans, so to take it from on a daily basis, directly from the people. The central bank has to support the whole digital environment, very important for mortgage servicing. So we need new ways here. We need new ways to reduce the default risk. And we know what way to go with that. And we have now many systems. India is absolutely at the forefront of it, to underwrite informally employed. Done very well. The mechanisms are known. We only have to borrow them from each other and adjust them to our local situation. It can be done, and the default rate on the informal portfolio is not much higher than the normal portfolio. We know how to do it. There are new tools that have proven themselves. We have ways to reduce the losses once a default has occurred. So first we must prevent defaults, of course, but then once a default occurs, I have to reduce my losses. And here we have new systems. You are from Brazil? No? Someone here from Brazil? The trust deed I single out as a very important innovation. It is not so new, but in Brazil, when they began to use the trust deed mortgage, meaning we have a mortgage and it is placed not with the bank, the deed to the land is placed in an independent legal entity overseen by legal experts, and the person who is paying for the mortgage and who owns the house only get access to the deed when they're fully paid up. In the meantime, the lender, in a case of default, does not have to go to the court. They can immediately take the house with the consent of that third party. So no legal hassle apart from that third party. That came into being in 2000 in Brazil. You can look at the figures so that you don't think I'm lying, but the mortgage sector took off in Brazil after this instrument was introduced. It's much better than tenant purchase. That has all kinds of difficult bells and whistles. The owner is the owner in this case. So that instrument requires your attention. Then we, of course, have credit guarantees, we have mortgage insurance, we have to facilitate mortgage foreclosure and help lenders.
In Brazil, we were able to build the covered bonds in Brazil. It's the only BRICS country covered bonds, only because of that.
Because of this instrument.
Otherwise, just to underline how important it was,
This way.
we started the negotiation with the Central Bank of Brazil and the Minister of the Hacienda, and only because of this legal certitude was possible to build a long-term asset around this. And Brazil is the only active covered bond market in emerging economies. So that was a fundamental, just to underline what you just said.
Yeah, and in Africa, unfortunately, everyone is focused on tenant purchase. Everyone here understanding what I'm talking about? But with a tenant purchase, you are a tenant in the house. That's very different. So do I take care of a house if I'm a tenant? No. Who is taking care of the management of the house? The lender? It doesn't work in the same way. So the Brazil model, I think, is much more promising. All right, I know I'm out of time, so I'm very stressed to we know how to lower transaction costs. There are so many stupid costs that when you look at them, both in advanced also, take title insurance in the United States, ridiculous, it's a scam. So we have our own costs that are ridiculous, but emerging markets can't afford them. So they have to be very diligent in cutting out all these extra fees and taxes. I mean, it doesn't make sense that a country like India, where the cost to get a mortgage is 27% of an affordable house, that they then go and subsidize that house. It makes no sense. Cut the taxes, for God's sake, and make it easier in the process. So I can go on about that. Very important part, and so are the regulatory costs, and I already talked about that. So we know how to do this. Let me summarize very quickly. Emerging market housing markets are severely impacted by the macroeconomic crisis. Mortgages have stopped. Basically, the mortgage market has stopped with the current rates. It's impossible. Formal housing, even less affordable, while the need is enormous. Showed you the figures. Top priority is expanding the scale of the housing finance system, particularly reaching the underserved segment of the population. I shared with you, we know how to do it. You just have to sit together and actually do it. People pay for their house. When they can afford it, they can pay for it. We have to create the basis for scaling up affordable green housing markets, and we can only do it through finance. If everyone continues to build in the informal sector, we do not get a handle on the green agenda. We do not. And that is an enormous problem. Okay? So we will need resources and help to emerging markets to implement that agenda. And I think as we speak, the G20 talked about it, they keep talking about it, but they have to get off the pot and do it, no? All right, concluding. Confluence of shocks impacting housing affordability. Housing, though, critical big sector of the economy. You cannot ignore the housing sector. You have to look it in the face. Housing finance can play an enormously catalytic role in advancing the green agenda and overcoming the problems that the macroeconomy plays on the housing market. So lending and investment products can be geared towards the green and sustainable agenda. The main challenges remain that this agenda is not yet cast in stone, but we are moving definitely in the right direction. Oh, I'm late.